Imagine this. You worked 35 years. You saved carefully. You put money away every single month when you could have spent it. You did everything right. And then, at age 73, a letter shows up. Not from your bank, not from your financial advisor, from the IRS. It's not a thank you note. It's a penalty for money you were legally required to take out of your own retirement account and simply forgot to. Or maybe nobody warned you. Maybe your advisor mentioned it once and moved on. Maybe the rules changed and you didn't know. Either way, the IRS doesn't care about your reason. They want 25 cents on every dollar you missed. And here's what makes this so quiet, so dangerous. No alarm goes off. No warning arrives in advance. You only find out when you're already in trouble. New data from Vanguard shows that nearly 600,000 IRA owners missed a required retirement withdrawal last year. Together, they could owe up to $1.7 billion in IRS penalties for a mistake most of them didn't even pay. No, they were making. If you have a traditional IRA, a 401k, or if you've inherited a retirement account from a parent or spouse, this video is for you. And if you haven't subscribed yet, hit that button right now, because we do this every week, and the next video might save you even more. Stay with me. By the end of this, you'll know exactly what to do. Here's exactly what I'm going to walk you through today. First, I'll explain what a required minimum distribution is. In plain English, no jargon. Then I'll show you the 3 mistakes that cause the most damage. One of them is something your own advisor may have accidentally set you up for. I'll also show you a completely legal strategy that lets some retirees satisfy their entire RMD requirement without paying a single dollar in income tax on it. And if you've already missed an RMD, don't panic. I'll tell you exactly how to fix it and reduce the penalty. Every number I give you today comes from the IRS, from Vanguard research, or from Fidelity's own data. No guessing, no fluff. Let's get into it. Now, before we dive in, I want to be upfront with you. This video is for educational purposes only. It is not financial, tax, or legal advice. Your situation is unique, and I always recommend working with a qualified tax professional. That said, the numbers I'm sharing today are real. They come from a December 2025 Vanguard study of nearly 400,000 IRA clients. They come from Fidelity's own retirement data, and they come straight from IRS.gov and publication 590B, the government's own rulebook on retirement withdrawals. This is an opinion. This is what's actually happening right now to real retirees. Let's start at the beginning, because I know some of you may be hearing this term for the first time, or maybe you've heard it but nobody ever explained it clearly. A required minimum distribution, an RMD, is exactly what it sounds like. A minimum amount of money the IRS requires you to take out of certain retirement accounts every single year. So once you reach a certain age, why does the government require this? Think of it this way. When you put money into a traditional IRA or a 401k, you got a tax break on the way in. That money grew tax deferred for decades. The IRS was patient, but at some point, they want their cut. They can't wait forever. So Congress created the RMD rule. Once you turn 73, I'll come back to that age in a moment, the IRS says you have to start taking money out. And when you do, you pay ordinary income tax on it, just like a paycheck. Here's how the math works. And I want you to stay with me because this part matters. Let's say your IRA balance was $500,000. At the end of last year, you're 74 years old. The IRS publishes a table. It's called the Uniform Lifetime Table in publication 590B that gives you a life expectancy factor based on your age. At 74, that factor is roughly 25.5. You divide your balance by that number. $500,000 divided by 25.5 equals about $19,608. That's the minimum amount you are required to withdraw this year. You can always take more, but you cannot take less. Now, here's the thing that surprises most people. You don't get to choose whether to take it. You don't get to decide you don't need the money right now. The government doesn't care if you're still working part-time, or if your portfolio just had a bad year, or if you simply forgot, missed that withdrawal, and the penalty kicks in. And that's exactly what we're going to talk about next. This is the most common RMD mistake in America, and it's also the most expensive case of simple forgetfulness you'll ever encounter. The deadline for most people is December 31st. Every year, no exceptions, no extensions. If that date passes and you haven't taken your full required amount, the IRS assesses an excise tax of 25% on whatever you missed. Let me put real dollars on that. Say your RMD for this year is $20,000 and you missed the deadline. The IRS charges you 25% of that amount. That's a $5,000 fine. And here's the part that makes it worse. You still owe the income tax on that money when you eventually do take it. If you're in the 22% tax bracket, that's another $4,400. 1 year of forgetfulness. $9,400 gone for money that was always yours. Now, I want you to hear this number because it really hit me when I saw it. Vanguard studied nearly 400,000 of their IRA clients. In 2024, about 6.7% of investors who should have taken an RMD didn't take one at all. That translates to roughly 585,000 IRA owners across the country. Together, they may owe somewhere between $680 million and $1.7 billion in penalties for a single year. But here's what makes this even more alarming. Among Vanguard's clients, the majority of investors who missed their RMD in 1 year also missed it the following year. The problem compounds. The penalties stack. Only about 3% of people who took their RMD on time in 1 year missed it the next. But if you miss once, the odds say you'll miss again. And there's one more piece of data I want you to hear, because it tells us something important. Among Vanguard investors with account balances under $5,000, minus small accounts people often forget they even have more than half missed their RMD. Meanwhile, only about 2.5% of investors with balances over $1 million missed theirs. The danger isn't just forgetting your main account. It's the old 401k from a job you left 20 years ago. The rollover IRA at a credit union you barely think about anymore. The IRS counts every account, every custodian, every dollar. So what do? I'll give you the most practical fix in the world, and it's free. Call your IRA custodian. Fidelity, Vanguard, Schwab, whoever holds your account, and ask them to set up automatic RMD distributions. Most major providers offer this at no cost. You pick the frequency, monthly, quarterly, or one lump sum in December. The system calculates your required amount, takes it automatically, and you never have to think about it again. It removes the human error entirely. And if you have multiple accounts at multiple custodians, you need to make that call at each one. Now here's where it gets interesting and a little frustrating, because the mistake I'm about to describe isn't really your fault. It's something advisors say that sounds helpful, but can quietly cost you thousands of dollars. Here's what happens. When you turn 73 and you're taking your very first RMD, the IRS gives you a grace period. You have until April 1st of the following year to take that first distribution. Most advisors mention this and move on. Good news. You have until April 1st. What they often don't mention, what the fine print doesn't explain, is that your second year RMD is still due by December 31st of that same year. So if you wait until April 1st to take your first RMD, and your second RMD is due by December 31st, you're taking 2 full distributions in a single calendar year. 2 years worth of income reported on one tax return. Let me show you why that matters. In dollars, imagine a married couple. They've been careful. They have IRAs totaling about $600,000. Their RMDs are roughly $24,000 per year. They decide to use the April 1st grace period on the first distribution, thinking they're being smart. Now they take $48,000 in a single year. Their income spikes. And here's the part nobody warned them about. Medicare looks at your income from 2 years ago to set your Part B premium. That's called the RMD surcharge. For 2026, it kicks in for joint filers above $218,000. Cross that line by a single dollar and you pay more. Not gradually, all at once, a cliff. For some couples, that double-year RMD pushes them over a threshold and triggers a Medicare surcharge of hundreds of dollars per month for 2 years running. That's potentially $2,000 to $4,000 in extra premiums because of a grace period that sounded like a gift. The lesson? Unless you have a very specific financial reason to delay, and sometimes there is a good reason, which is why you should talk to a tax professional. Taking your first RMD in the same year you turn 73 is almost always the cleaner choice. One RMD, 1 year, no doubles, but we're not done. Because the biggest mistake of all is coming up next. And it's one that's affecting people right now in 2025 and 2026 who inherited an IRA from a parent and have no idea the rules changed. This one, I want you to pay close attention to. Share this section with your adult children, your siblings, anyone who has inherited a retirement account from a parent or loved one in the last few years, because the rules changed and most people don't know. Here's the background. Before 2020, when you inherited an IRA from a parent, you could stretch out the distributions over your own lifetime. A 50-year-old inheriting a $300,000 IRA could take small withdrawals over 30 or 40 years. Very manageable. The Secure Act in 2019 eliminated that for most non-spouse beneficiaries. Now, if you inherit an IRA from a parent or non-spouse who passed away in 2020 or later, you have 10 years to fully withdraw the account. But here's where it got confusing. The IRS spent several years, 2021, 2022, 2023, 2024, issuing guidance and penalty waivers while everyone figured out the rules. Many beneficiaries were told or assumed that they could just wait until the 10-year deadline to take everything out in one lump. In July of 2024, the IRS issued final regulations, and they were clear. If the person you inherited from had already begun taking their own RMDs, meaning they were 73 or older, and had started distributions before they passed, then you, as the beneficiary, are required to take annual distributions during your 10-year window, not just a lump sum at the end, required amounts every year. And starting January 1st, 2025, the penalty waivers are gone. The 25% excise tax applies. Fidelity reported that as of late November 2025, 53% of their clients who needed to take a 2025 RMD still hadn't taken one, and 29% of those outstanding distributions were from inherited IRAs, people who simply didn't know the clock had started. Here's what that looks like in real dollars. Say you inherited a $200,000 IRA from your mother, who passed away in 2021 at age 76. You knew about the 10-year rule, but you didn't take anything in 2021, 2022, 2023, or 2024 because the penalties were being waived. Starting in 2025, your annual RMD might be approximately $13,000. If you miss it, the IRS charges 25%, roughly $3,250 in penalties. Plus, you'll still owe income tax on the distribution when you take it. And your 10-year clock is still ticking. You don't get extra time. Important note here. You do not have to make up for the years the waivers covered. The IRS is not going back and charging you for 2021 through 2024, but 2025 and every year forward. You're required to take your annual distribution. If you're not sure whether you fall into this category, call your IRA custodian today, not next week, today, and ask them one specific question. Am I subject to the 10-year rule? And if so, am I required to take annual distributions? That one phone call could save you thousands. Okay, now for the part of this video I know you've been waiting for. Because here's the truth. Everything I've told you so far has been about danger, penalties, mistakes. But there is a strategy, completely legal, IRS approved, and available right now, that lets some retirees satisfy their entire required minimum distribution without paying a single dollar of income tax on it. It's called a qualified charitable distribution, a QCD. Here's how it works in plain English. If you are age 70 and a half or older, you are allowed to send money directly from your IRA to a qualified charity. The money goes straight from the IRA to the charity. It never passes through your hands. And because of that, the IRS does not count it as taxable income. If you direct your IRA custodian to send $15,000 to your church, your favorite nonprofit, or your local food bank, that $15,000 satisfies your RMD requirement for the year, and not one penny of it shows up as income on your tax return. Let me show you what that means in real money. Say your RMD is $15,000 this year, and you're in the 22% tax bracket. Normally, taking that withdrawal adds $15,000 to your taxable income. At 22%, that's a $3,300 tax bill. If instead you direct that same $15,000 to charity as a QCD, your taxable income does not increase. You keep the $3,300, and it goes further than that. Lower taxable income means your Medicare RMD surcharges may stay lower. It may mean less of your Social Security is taxed. For some retirees, one QCD can ripple through their entire tax picture in a very positive way. The limits for 2025 are $108,000 per person. In 2026, that rises to $111,000. A few rules to keep in mind. The money must go directly from your IRA to the charity. You cannot receive the check and then donate it. That doesn't qualify. The charity must be a qualifying 501c3%, and QCDs cannot come from a 401k. They must come from an IRA. Now here's the counterintuitive bonus I mentioned at the beginning of this video. You can start making QCDs at age 70 and a half. 2.5 years before RMDs even begin at age 73. By donating from your IRA between those ages, you reduce your total IRA balance. And a smaller balance means a smaller required minimum distribution when the time comes. Most people have never heard this. Your advisor may never have mentioned it, but it is one of the most effective, perfectly legal ways to manage your retirement tax picture in the years leading up to required distributions. Before we wrap up, I want to speak directly to anyone watching this who just realized they may have missed a distribution. Take a breath. This is fixable. The IRS penalty for missing an RMD is 25%. But if you correct the mistake within 2 years, that penalty drops to 10%. And in many cases, when the error was honest, when it wasn't habitual, when you corrected promptly, the IRS has been willing to waive the penalty entirely. Here's the exact process. Step 1. Take the missed distribution as soon as possible. Call your custodian today. Don't wait. Step 2. When you file your tax return, include IRS Form 5329. This is the form you use to report the missed RMD and request a penalty waiver. Step 3. Attach a brief letter of explanation. Keep it simple and honest. I was unaware of the rule change. I have since taken the required distribution. I am requesting a waiver. That's it. Step 4. Wait for the IRS response. Most tax professionals who do this regularly say the IRS is lenient with first-time prompt correctors. They would rather you comply than punish you. Here's what the numbers look like in practice. Say your missed RMD was $15,000. If you do nothing, the penalty is 25%, which is $3,750. If you take the distribution now and file Form 5329 within the 2-year window, the penalty drops to 10%, which is $1,500. That's $2,250 you keep just by acting quickly. And if the IRS grants the waiver entirely, you pay nothing extra beyond the regular income tax on the distribution. The worst thing you can do is nothing. Penalties compound. Missing it 2 years in a row doubles your exposure. Now here's what almost nobody tells you. And I want to say this slowly because it reframes everything we've discussed. The Secure 2.0 law that Congress passed in 2022 was sold to retirees as a gift. The penalty for missing an RMD went from 50% down to 25%. The RMD age went from 72 up to 73. More time, less punishment. And that's all true. Those changes were real and they do help. But buried inside Secure 2.0 and finalized in IRS regulations in July 2024 was a new obligation. The inherited IRA annual distribution requirement, a rule that actually added more situations where people owe required distributions, a rule that was waived for 4 years while people got used to it and then quietly reactivated. The government gave with one hand lower penalties, later start age, and quietly extended the net with the other. The April 1st grace period is the same story. The rule sounds generous, extra time to take your first distribution, but it doesn't tell you about the second RMD due 9 months later, or the tax bracket spike, or the Medicare surcharge that follows 2 years after. The QCD is the same. It's been in the tax code since 2006. It's fully legal. It can save some retirees thousands of dollars a year, and almost no one knows about it. The system is not designed to help you avoid mistakes. It's designed so that if you don't know the rules, the real rules, all of them, the IRS quietly wins. The only protection is knowledge, and that's exactly why you're here. B-roll Q, wide shot of government building or IRS headquarters, then cut back to warm kitchen table setting. Here's the one thing I want you to carry with you from this video. The RMD system is designed so that if you do nothing, the IRS wins. And the only way to protect yourself is to know the rules, act before December 31st, and understand that a quiet mistake in retirement can cost you thousands of dollars you spent decades saving. Write that down if you have to. Let's make this real. Here are 3 things you can do this week. Small steps, doable. First, verify your RMD status. Log into your IRA or 401k account, or call your custodian and confirm exactly when your first RMD was or is due. If you turned 73 this year or last year, that conversation needs to happen today. Second, set up automatic RMD withdrawals. Ask your custodian to automate the distribution. Fidelity, Vanguard, and Schwab all offer this for free. Set it once, and it runs every year without you having to remember. Third, if you inherited an IRA from someone who passed away after 2019, call your custodian and ask one question. Am I subject to the 10-year rule, and am I required to take annual distributions? Get the answer in writing. And if you've already missed a distribution, don't wait another day. Take it now and talk to a tax professional about filing Form 5329. The sooner you act, the more you save. Imagine this. You worked 35 years. You saved carefully. You put money away every single month when you could have spent it. You did everything right. And then, at age 73, a letter shows up. Not from your bank, not from your financial advisor, from the IRS. It's not a thank you note. It's a penalty for money you were legally required to take out of your own retirement account and simply forgot to, or maybe nobody warned you. Maybe your advisor mentioned it once and moved on. Maybe the rules changed and you didn't know. Either way, the IRS doesn't care about your reason. They want 25 cents on every dollar you missed. And here's what makes this so quiet, so dangerous. No alarm goes off. No warning arrives in advance. You only find out when you're already in trouble. New data from Vanguard shows that nearly 600,000 IRA owners missed a required retirement withdrawal last year. Together, they could owe up to $1.7 billion in IRS penalties for a mistake most of them didn't even pay. No, they were making. If you have a traditional IRA, a 401k, or if you've inherited a retirement account from a parent or spouse, this video is for you. And if you haven't subscribed yet, hit that button right now, because we do this every week and the next video might save you even more. Stay with me. By the end of this, you'll know exactly what to do. Real quick, if this video helped you today, I want to ask you a favor. Hit that subscribe button and ring the bell. Every week I break down exactly this kind of thing. Retirement rules, tax strategies, Medicare, in plain English, with real numbers, no fluff, no selling, just information that could protect what you've worked your whole life to save. You deserve to know this stuff. And now you do. Look, I know that was a lot. RMD rules are not supposed to be this complicated. But Congress and the IRS have rewritten them 3 times in the last 6 years, and most retirees are still playing by the old rule book. The good news? You're not. You now understand things that most people your age have never heard. You know about the December 31st deadline and why you should take it seriously. You know about the April 1st trap. You know about the inherited IRA rule that came back in 2025. You know about the QCD strategy that can potentially eliminate the tax on your entire distribution. That knowledge is worth real money. If this video helped you, do one thing for me. Share it with someone you care about. A parent who just turned 73. A sibling who inherited an IRA. A neighbor who's been putting off thinking about this. They may not know any of this. And now you can be the one who told them. Drop a comment below and tell me, do you have a traditional IRA, a 401k, an inherited account, or all 3? I read every comment, and I'd love to know where you're starting from. I'll see you in the next one. For educational purposes only, not financial, tax, or legal advice. Please consult a qualified professional before making any decisions about your retirement accounts.